I think historically, private market assets or alternative assets have provided some of the biggest returns or some of the best. I think what's quite attractive to some alternative assets is that they're not as correlated to the economy as public markets are. So they can provide a certain level of security within a portfolio, and they might not experience some of the same ups and downs as public market assets will when the economy goes up and down.
We'll be investing in funds across a range of private market asset classes, not just venture capital, private equity, real estate, private credit, etc. So while initially we will be making direct investments into companies, long term I think our real strength will be in finding and selecting the best investment managers and funds to invest in on behalf of our investors.
Hi there, and welcome to Stock Club, a podcast brought to you by MyWallSt. Joining myself and Emmett on today's episode are Scott Ashmore and Rob Halligan, the co-founders of PitchedIt, an Irish company looking to unlock the potential of private market investments. Every month, we publish our Stock of the Month in our Invest Plus service here at MyWallSt, so Stock of the Month has an unbeaten track history of success. It's about 5x since we started the service compared to the S&P 500, which is up about 2x, so we're doing pretty well there. Not only that, but with Invest Plus, you also get our 10 foundational stocks, a library of about 60 stocks and counting, your weekly Charging Your Fearless newsletter, and if you have any room left, we've also included a bonus wildcard report on top of all that. So for our loyal Stock Club listeners, you can get €50 off this bundle with the promo code StockClub50. StockClub50, all caps, and that's going to give you a nice little discount there. You can click on the link in the show notes to access that too. Before we get into the show, our podcast is brought to you by Vodafone Business. Now, if you're like us here on MyWallSt, you'll know that running a business is difficult. Countless things to think about, many often simply get ignored or completely forgotten about. That's where Vodafone Business can help. They've crafted a suite of tools and supports to boost your business's operations, and the best part is it's free for everyone. From cybersecurity to harnessing the power of AI, building a website and improving how your business operates, Vodafone Business will help you address the often overlooked but crucial elements to your business's success. To get started today, check out their one-to-one VHub digital support and advice service. You'll find everything you need right there. You can go on the link in our show notes or simply just Google Vodafone VHub for more details on that. Now, let's get into today's episode.
Hello everyone, and welcome to Stock Club, your weekly dose of all things stock investing interwoven with Irish style chit chat. This week we're going to break from the usual format for an interview with two entrepreneurs doing something that I really liked the sound of and thought was worth discussing. Scott Ashmore and Rob Halligan are co-founders of PitchedIt, which is designed to build a diversified portfolio of private market investments. And according to PitchedIt's data, private markets present an opportunity to achieve higher returns compared to public markets due to the ability to invest in companies during the earlier stages of growth. And that's why we're all here on this podcast, to get an edge on the journey of wealth creation. Rob and Scott, welcome to Stock Club. Okay, well, first up, Rob, I'm going to hit you with the first question before we dive into understanding how to do all that's promised on PitchedIt's site. Can you give us a very quick summary of the different stages of a business's funding life cycle? Because as stock investors, we're only used to considering capitalization options after it's IPO'd. But can you just give us a very, whistle-stop tour of the earlier stages of a business getting the money to do whatever it is they need to do?
Yeah, no problem at all. So there's a number of different stages from the inception of a company all the way out to when it's likely to IPO or list. They won't necessarily all follow the exact same path. There's no set rules, but typically what you see is at the very, very start of a company's journey, when I'm talking about an idea or concept here, you might see friends and family money being the first capital injection into a business. So, exactly what it says, it's going out to the people who are closest to you to get some funds to explore the idea that you might have. After that, you'll see pre-seed and seed rounds. Seed being considered the first official round of fundraising and will often include maybe a VC that's leading the round and some angel investors. But pre-seed, I guess, kind of sits somewhere in between the friends and family and the seed round, and can often be a mix of both friends and family money as well as some more, I guess, official investors, whether they're angels or syndicates or VCs. After that, but still considered early stage, is your Series A and your Series B. A company might raise a Series A once they've found some product market fit. And then into your growth stages is your Series C, your Series D, E, and so on. Usually once you get to the kind of D, E, F stage, that's when companies are are at a position where they're looking to float or to IPO, so they won't necessarily always go as far as an E or an F. But as I said, every company is a little bit different and doesn't necessarily follow the exact same path. But typically, that's what you're going to see. And of course, then there's debt as well, which is the other side of it. But from an equity perspective, that's the route that a lot of companies will follow.
So the companies that we're discussing here, specifically pre-IPO, are typically Series A, B, and would we say C? Would we go that far down the runway?
Yeah, so we're actually going to be focusing on as early as pre-seed and seed stage companies as well. I think Series A, B, C is a very, very popular space for investors because the startups themselves have kind of exited that early and super risky stage and got into a place where they've kind of starting to find themselves or have found their place in the market and are experiencing some growth, and they have that product market fit. There's a lot of opportunity in the earlier stages, in the pre-seed and seed stages, and I think that there's less investor focus, although it is starting to change a little bit, but there historically has been maybe less investor focus from an institutional perspective in the pre-seed and seed stages. So we're definitely going to be focusing on the earlier stages, probably the pre-seed, seed, and Series A, and less so on the later rounds.
Scott, for years I was reading Paul Graham's blog at Y Combinator in order to get a view of what they were investing in, because it was a really good indicator of the teams that were coming down the railway line for public markets. So, for example, Y Combinator invested in Stripe and Dropbox. It invested in Airbnb, in Instacart, it invested in DoorDash. It really got in early on so many of the world's biggest brands. And I suppose it was a key contributor to them getting up the ladder and out the door into the IPO market. They invested in Cruise, they invested in Ginkgo Bioworks, biotechnology, just so many more of them. And then, so as a result, they published these teams that was interesting to them. And I remember years and years and years ago, they said they were looking to invest in the great disruptor for email. And as far as I know, they invested in Slack. And this was typical of their blog matching their investment thesis. So effectively, it's almost like a crystal ball for IPOs in 3 years from now. Do you foresee PitchedIt delivering similar insights?
I mean, if we were able to create the value like Paul Graham has with Y Combinator, that would be incredible, what they've managed to achieve over the last kind of 20 or so years in terms of returns to their investors, but also the spotlight they've shown on the startup ecosystem and the support they give to startups has been phenomenal. So to achieve something like that would be absolutely incredible. But I think ultimately our vision is to provide investors with access to an array of assets, not just venture capital. So this means, we'll be investing in funds across a range of private market asset classes, not just venture capital, private equity, real estate, private credit, etc. So while initially we will be making direct investments into companies, long term, I think our real strength will be in finding and selecting the best investment managers and funds to invest in on behalf of our investors. And what this kind of approach enables us to do is diversify at a scale that's just simply unachievable with direct investing. We really want to just create a basket of private market assets that's really simple for investors to understand and invest in. And maybe one day we'll create an index of YC companies. I think that would be pretty cool.
So on that then, in what you're probably targeting for PitchedIt, what types of businesses or companies would you typically be investing in or targeting to invest in?
I don't think we have any specific target that we're targeting. I think AI is a pretty clearly a dominant sector right now, but I think the space is quite saturated now.
And probably way overpriced as well. Would that be fair to say?
Yeah, exactly. It just makes picking winners extremely difficult. And I think, there's a saying, if a sector is red hot, it's probably too late. The big winners have already been invested in. There's always a theme or a fad that's popular. It goes in cycles. I think the reality is that it's near impossible to say one sector is going to deliver returns superior to another sector. But yeah, I think beyond AI, there's still huge opportunity in financial services, especially in emerging markets, but also in developed markets as well. Like if you just look at the banking systems in Ireland, we're still lagging way behind. So I think there's still a lot of value creation there in terms of technology, especially with advances in AI lately. But again, I'm no expert, but I think healthcare as well. I think with the introduction of AI now and how advanced AI algorithms are getting, just in terms of developing drugs and things like this. And it will make a huge strides in the healthcare market, just in terms of making it more accessible, lowering the price points for people, especially when you look at companies like the US.
Yeah, and I suppose private markets and especially venture capital markets the companies looking for funding there are going to be of a certain type in terms of high potential, high reward down the line. But again, not, there's not going to be private HVAC companies on the venture capitalists anywhere close. So then, what is it about private markets or alternative assets, we'll call them, that you find most attractive? And equally, what are the biggest risks? Because we kind of touched on it there a small bit.
Yeah. I think historically, private market assets or alternative assets have provided some of the biggest returns or some of the best returns, but they've been largely inaccessible for 99% of retail investors. And there's a certain exclusivity to private markets. They've been seen as kind of, the 1% clubs can only access, things like hedge funds and private equity. They haven't been accessible to most people. And I think that lack of access probably left a bit of a chip on the shoulder for me and Scott. Like, why can't people like us get access to opportunities like these? And we felt like they should be open to everybody. I think, outside of the returns, I think what's quite attractive to some alternative assets is that they're not as correlated to the economy as public markets are. So they can provide a certain level of security within a portfolio, and they might not experience some of the same ups and downs as public market assets will when the economy goes up and down. So they can be used as a bit of a hedge to market volatility. Depending on the asset class, more so, some more so than others. Things like art, for argument's sake, aren't correlated to the market pretty much whatsoever. So you'll often see a lot of wealthy people investing in art as a way to hedge and provide some security within their portfolio. But again, most people will probably think, well, that's completely out of reach for the majority of people to invest in high quality artwork. But there's even companies now that are allowing people to do that for small tickets to get access to really, really high quality famous art.
Like Masterworks, I presume.
It's exactly.
Yeah. We interviewed their founder, actually. We interviewed their founder and he was in a common workspace and it was the background noise was so loud. It will go down. We've some pretty shitty podcasts, but this will go down as the worst of all because it was basically like we put a microphone in the middle of Fifth Avenue and stood on the other side of the road and shouted across the road to conduct an interview. But I do like what Masterworks is doing. I still haven't participated, but it's a nice idea.
I signed up because I was really interested to see what they were doing. And I mean, if you look at some of the paintings or the actual artists that they have on, it's quite impressive. But yeah, so I just think, there's a lot of opportunity, and I think it's a great opportunity to diversify and, provide some security within your portfolio as well. I think, there are risks obviously associated as well, and people need to be aware of that are quite different to public market assets. There is a capital lockup, right? There is the liquidity issue there as well for the large part. You can expect that your investment is going to be, or your money is going to be invested for quite a long period. You can't just get in and out like you can in the public market. So that's obviously something that people need to be aware of going in.
It's probably promoting good traits, good investing traits though, isn't it? Like this, we always preach a long-term buy and hold strategy, but it's a lot more difficult to do when you go and turn around and see one bad news story and sell it in the morning. You can't do that with private investments. No,
you can't. So I think you see a bad news story and it obviously triggers people to start panicking, and then that's you see everyone selling. That can't happen. So like it or not, your money is going to be locked up for likely a considerable period.
You'd want to be fairly zen, all right?
Yeah. Well, whether you are or you aren't, once you're in, you have no choice anyway. So I guess you're just going to have to deal with it.
Yeah, I've sat on both sides of the table. I obviously have founded a business that's raised capital on a lot of different steps that you just defined. And when I've pitched to friends, family, and nearly friends and nearly family, and those who are just, let's say, only 2 or 3 degrees of separation away, I've always been conscious of the fact that once you've invested in this private entity, there's no absolute like date on the wall that says there's going to be a liquidity event. We can tell our shareholders we're going to aim for a liquidity event at a certain point in time, but generally the best made plans are laid to rest. And equally, I've invested in probably 30 or 40 startups, and I have yet to see one where a liquidity event was at my disposal. It just doesn't happen, you know?
Yeah, absolutely. There's of course there's no guarantees of these things, but or certainly the timeline of when they might land. But with the likes of PitchedIt, there's some things that we can try and do, such as secondary marketplaces on platform where people might be able to sell their shares at a certain date in the future. Again, there's no guarantees. You obviously still have to have someone interested in purchasing those shares, but we'll certainly do what we can to provide that. But again, I think if you're investing in private markets, you should go in with the belief that your money is going to be locked up for kind of 5 to 10 year period.
Yeah, a lot more people could, if they went into public investments with that attitude, would serve a lot better. There's one, this is kind of esoteric, but I wanted to talk about it here. Have you heard about this Destiny Tech 100 fund just recently? So it's getting a lot of headlines. I think it went absolutely nuts. That's something like a net asset value of $50 million and a market cap of $800 million at one point, which is a bit of a stretch. But for people who don't know, it's a public fund set up to accumulate positions in private companies. And it's listed out its holdings. I think 30% of it is SpaceX. It's got companies like Stripe. What you're saying, these companies people want to invest in can't. It's claiming it's giving access to. I just love to hear your opinion on this.
Yeah, absolutely. I think first and foremost, well, I don't know a huge amount about it. I did take a glance at it, and I saw there's quite a high caliber of the companies that are in the portfolio are of quite a high caliber, as you mentioned, SpaceX and a few others that are in there. So it looks really interesting. I think any opportunity for retail investors to have access to private markets is great and great to see. If you look at the small print, I think I had a glance at it. I think it was for US citizens only. Certainly when you go through the sign-up process, and I can happy to be corrected here on this, but I know that it mentioned you have to have, I think it said US citizen and a US mobile number. So I'm not sure if it's open to everybody or if it's not open to everybody yet. I could be wrong. But more avenues opening up, I think, is a great thing. I also came across some other similar ones in the UK, HD Capital Trust, which again is 100% private market positions listed on the London Stock Exchange. Not quite the same household names as some of the companies in the Destiny 100. And another one was the Scottish Mortgage Investment Trust, which I think is about 30% private companies, but the private companies that are in it are of a really high caliber. A lot of the same names that you'll see in the Destiny 100. So I think it's brilliant. Like, I think you're seeing there's also platforms that are opening up that are allowing people to buy positions or get access to these type of companies buying secondaries, which I think is great. I think it's a great opportunity for people to get access. Now, how they pan out, it's hard to say, but I think from a face value, they look quite good.
I think the IPO market has been quite non-existent lately, so it's very difficult to kind of value where private tech companies are at in terms of IPOs. Obviously, we just saw the Airbnb, or not the Airbnb, the Reddit IPO. I think that was priced at $6.5 billion, and then it was, last time I checked, it was trading at $9 billion. But I'm not sure what it is at now. It might have dipped a bit, but it's hard to know. It's hard to place value on pre-IPO tech companies at the moment.
I'd love to dive a little more into PitchedIt and what you've done and where you're going, because I think that's the most interesting part of this conversation. But before we do, I suppose it's fair to say that investing has massively increased in popularity, especially with younger generations over the last 10 years or so. Why is that the case? And what do you think is the biggest barrier to getting started in investing?
I think technology is really the core ingredient that has created this. I mean, even if you think back 10 years ago, what was available to you on your phone versus what's available to you now. Even most non-investors probably have Revolut on their phone, which means they have an access point to invest directly in either stocks or cryptocurrency, I think is what, and Square for our American listeners, absolutely. So I think technology has not only provided the tools that make it very, very simple, but also have, I guess technology is the reason behind the kind of dissemination of information as well, right? So people have access to the information, which means people's financial literacy is probably at a different place that it was 10, 20, 30 years ago, your average person. And I think that has caused a massive shift. And like I was reading a report recently about Gen Z investors. So young investors now is predominantly focused on the US, but it was saying that 56% of 18 to 25-year-olds are investing, right? Which I think is quite, if I think about when I was 18, investing was, far away from any of my thoughts, nor was I even able to get access because that, the technology wasn't there, the ability to do it wasn't there, certainly that I was aware of. But I don't think it was very. I think the numbers mentioned that it was quite not too far off that in the UK as well. So I think it's just people are starting much younger because of technology. So that's kind of giving people the access point. And then I think when you look at maybe some of the little bit older than the kind of 18 to 25 bracket, you have things like people who are starting their careers and now they're looking at job insecurity, cost of living, the inability to afford a house. I mean, if we saw in the last few years like how people were let go from jobs, companies they were loyal to that obviously weren't loyal to them, people who probably felt quite secure in their job and that was their obviously main source of funds. I don't think anybody can probably, or most people probably don't feel very secure in their job after you saw. I mean, I know people who have been in companies for a very long time, very high achievers, who were let go via email, right? So I think people now are looking at it and thinking, well, maybe I can't rely solely on my salary anymore, and I do need a bit more of a safety net or another source of funding that can support me or provide me with just a little bit more freedom if needs be. So I think that's also been a bit of a driver that's pushing people towards investing as well.
So you mentioned tech. I suppose tech is an enabler and you're building a tech platform. So I'd love you to just tell me, because the three of us, Mike wasn't with us, the three of us met for coffee. We were introduced by a mutual friend and I was fascinated at what you're in the process of building. And what I'd love to do is just kind of lift the lid a little on PitchedIt and maybe for you to explain to me what makes it different to other private market investment platforms. And while you're at it, tell us what is a viable PitchedIt investor / customer, because you mentioned the fact that whoever those lads were you mentioned a minute ago, like take American customers, but it seems like every jurisdiction has its own kind of Chinese wall around it, you might say. So what makes PitchedIt different and what type of person are you hoping to attract to your platform?
Yep. So as you mentioned, there's a number of kind of private market investment platforms or alternative investment platforms out there. The biggest issue we found when looking at all of these was that they predominantly only support accredited investors. So meaning that you have to have a certain salary level or net worth, which ultimately rules out the majority of people, which means that they're not being supported. And it's the typical problem that's always been there with private markets, right? Is that it's inaccessible to most people. And while it's great to see companies that are building within the space and trying to create these access points, regulation means that for the most part, a lot of them can only accept or support accredited investors, which is a real shame. So that's something that we want to focus on, and our platform is open to all retail investors, accredited or not. So that's one of the biggest issues. And within a lot of those platforms as well, even though some of them will say they support non-accredited investors, when you dig a little bit deeper and look under the hood, if you are a non-accredited investor, they have minimum investment or entry amounts, minimum ticket sizes, often above $10,000 or 10,000 euros, which makes it inaccessible for most people regardless, right? So I think that's a real shame. Where there hasn't been a barrier within the private markets is, your traditional crowdfunding platforms where people can invest directly in startups. One of the biggest problems here is that the model that traditional crowdfunding platforms use means that they're not necessarily incentivized to provide a return for the user, for the investors on their platform. They make money by collecting success fees on the success of a round, as I'm sure you're aware of. And because of that, they will often work off volume. So the quality of, they need quantity of opportunities running through the platform in order to hit those revenue numbers. And as a result, the quality of opportunities can often come into question. We have a very different model. We charge an annual subscription fee for users to access the platform. That means that we don't have to rely on volume. We can instead focus on finding the highest quality opportunities for our users. And ultimately, users want high quality investment opportunities, and they want a great user experience, and they're willing to pay for it. In regards to the actual customer, so kind of our ideal profile or ideal customer, what we're looking for is we're, I guess, targeting that gap between your typical crowdfunding investor who might be investing 50 or 100 quid here and there, and your kind of angel investor. So typically maybe 20,000 euro checks or above. I guess the profile is 25 to 44-year-olds, people who you might consider in that mass wealthy category. So earning 75,000 to 250, I think is the category that's defined by. But ultimately, people who like to invest, they might not necessarily invest in alternatives or private markets, but have invested before and may have invested within alternatives as well.
So, Will, so I can get a clear picture on this, can an American citizen sign up with PitchedIt?
American citizens can sign up with PitchedIt. As per the regulations, we have to be careful about who we're marketing to. The laws allow us to support startups and investors across the wider EU, but that's not to say that there's necessarily major barriers for other investors. But we do have to be careful. Obviously, we're a regulated financial services platform, and who we support and who's allowed to use the platform is important. But the regs allow us to support kind of the wider EU. The goal for us is ultimately to look further afield to the UK and to the US as well. However, that obviously means a different set of laws, a different set of regulations that need to be hurdled first. So the EU is our starting point.
Before I hand over to Mike for the most important question we always ask our guests, I just want to hit you with one or two things. When are you launching? Would you like our listeners to enter their email for something or another? And what do you hope or anticipate will be compounded annual, or the CAGR, the compounded annual growth rate for someone who goes the journey?
Yeah, so we'll be launching midsummer in July. For anybody who's interested in signing up, or even just learning a little bit more about what we're doing, what we're building, you can find us at pitchedit.co, and from there you can join our waitlist. And once you're on our waitlist, you'll receive information from us regarding our upcoming launch. And you can also reach out directly to myself and Scott if anyone's keen to know more, would like to chat about what we're doing. Would always be happy to chat with anybody.
And the important one, so the S&P, the S&P returns about 10.5% per year. Just the opportunity to get in earlier. What is your target CAGR?
Well, I think if you look historically at kind of early stage venture, the CAGR is around anywhere between 16 and 30%. It depends. Like if you were investing with a top decile fund, then your CAGR is going to be much higher, towards that 30%. But if you're investing kind of the top quartile, bottom of the top quartile, you're going to be around the 16%. So it's very important that we're investing in the best opportunities. But yeah, if we're above 16%, that would be a good achievement.
Nice. So it sounds like you're about to democratize early stage investing for the masses. And that's why I really liked the sound of your platform. Mike, over to you. Hit the guys with the big question. What our listeners want to know.
This is putting you on the spot a small bit, since clearly your expertise are in private, not public markets, but you are investors, and we ask everyone who comes on this show the same question. So we said 3 in the question. It can be as many or as few as you want, but just a couple of public companies that you admire from an investing perspective you could buy for today and maybe hold for the next 20 years.
Yeah. Yes. A few come to mind. I think, and this one, I wouldn't be surprised if somebody's already said this on a previous episode that I missed, but I'm probably quite unoriginal. But Nvidia for no, no, not quite. Nvidia for obvious reasons. I think given the AI boom, that's not going to slow down anytime soon. I think they're going to be heavily tied to that. And even though their stock has been, exploding, I think that there's still a ways to go in regards to what they'll do there and their ownership within that space. So I think that's one that is unlikely to go anywhere, but up for the next while. I worked at Salesforce for 6.5 years. I've always admired them and how they innovate. The way that they acquire businesses and make them, a native part of their platform offering has been really interesting. Companies like ExactTarget, Demandware, MuleSoft, the 2 biggest ones, Tableau and Slack. Slack one hasn't gone quite to plan in terms of the growth, but I actually just read this week that they're looking at Informatica, I think, as a potential acquisition target for obviously for reasons around their AI capability and how they'll embed those solutions into the Salesforce platform. But the way I think Salesforce, when I joined the company in mid-2015, was at $70. I think last time I checked, it's now roughly around $300. And I think that I just wouldn't ever rule them out, having worked there for so long and seeing how they operate. And now with the boom of AI, it'd be interesting to see how they take advantage of that and incorporate it into their current solutions. So Salesforce for me. And then one other one would be Microsoft, purely because of their relationship with OpenAI. They're obviously best buds with OpenAI now after the big investment that they've made, and they're so heavily tied to them.
They claim to be. I think OpenAI might have other issues.
Well, yeah. I think that they're not always aligned in terms of their thinking there. But I think from where we stand right now, OpenAI, it's hard to argue OpenAI won't be the kind of the company to watch for the next decade, right? If Microsoft's relationship with them stays healthy, they'll ride that out. And I think for those reasons, Microsoft is an interesting one as well.
Thanks, Rob. Scott, what about yourself?
Yeah, I mean, well, I'm not a stock picker. I never consider myself a stock picker. So if somebody gave me 10K tomorrow, I'd put it in the S&P 500.
That's not a wrong answer at all here either.
That said, I do have a soft spot for Airbnb. And just because of Brian Chesky, I think he's an incredible leader. And what he's managed to do, that company went into big trouble when COVID hit, and how he managed to turn it around, and just kind of his management style and how he gets so involved in the business. He's really in the details. So I think, maybe 2.5K in Airbnb and 7.5K in the S&P 500.
Love it. Gentlemen, it was a pleasure to meet you again and interview you here on Stock Club, and very best of luck with PitchedIt's launch this June. People go to pitchedit.co and drop your email in there for a very interesting and engaging weekly blog from the 2 lads about early stage investing. I'll certainly be a customer, and I'm looking forward to seeing how the business evolves. Mike, what's the story? Have I to say anything else? Will I talk about the sneak peek?
I was just about to say, I've been doing too many questions and not enough answering. So we have you on sneak peek before we close out the show.
Oh yeah, sneak peek. So this is our new weekly segment that everybody waits for. It's the best bit. It's where I give a teaser as to what's coming up in MyWallSt. And if I hold back enough detail, people will sign up. And if I give too much detail, they'll stick it into the ChatGPT and figure it out. So next Thursday, I'm going to pitch a stock on Horizon, which, as I said on a Horizon discussion thread, which we have in Telegram now, it had a confluence of coincidences in my life. My wife is completing her Institute of Directors qualifications, where, as it happens, the founding CEO is in her class, only for me to further discover that Bill Mann of the Motley Fool, and who attended our Horizon special event in November, knows the founder and interviewed the founder. And then only for me to find out that Bill is not only a huge fan, but also is an investor in the company. So apart from having two at least known second degree connections, I'm also highly likely to invest in this company, hold it for 10 years. I think it's an absolute beauty. It's so small. It's so effective. 9 out of the 10 biggest companies in its industry are customers. And it's as hidden as they get. I just think it's going to be an absolute face melter. So that's going live on Horizon next Thursday.
Perfect. All right. Thanks, Rob and Scott, for joining us. It was a great chat. Emmett, thanks as always. Before we finish up, thank you as well to our friends at Vodafone Business. If you're a business owner in need of a leg up when it comes to your digital transformation, get yourself over to Vodafone VHub to book your appointment today. You can also find the link in our show notes. That's it for today's show. Remember to grab your discount for Invest Plus for all Stock Club listeners. You can get avail of our market beating stock of the month picks and so much more if you just enter Stock Club 50 at Stock Club 50 all caps at checkout. Thanks for joining us today, and we will talk to you next week.